Guys, am I audible? I think now I would be. So, all right, everyone, welcome to the session again. I think now I would be audible. So, welcome to, now you'd be audible. Now I would be audible to you. Hi, Yash. Hi, Deepak. Everyone in the class, welcome to the session. Good afternoon. Everyone, please. Who all are here? Deepak, Chandra, Gauri, Yash. Who else is here in the class? Live. Good afternoon, people. Yes, how would you get my number? In the description of the same video that you're watching, you will be able to have my number. One second. Great. Yes, that's true. So Jahan is here, Gopi is here. Zeba Anwar, what's your first name? Sai, were you there in the last lecture? Were you there in the last lecture? Miral is here. Hi, Miral. Hi. Ishwari, were you there in the last lecture? Hi, Soumya. Good evening. Good afternoon, everyone. So, what is the rule, by the way? When do you wish evening and when do you wish afternoon? I think the finance concepts were being taught really well, but not the basics of when do you have to wish morning and when do you have to wish afternoon and evening. Purshi is here, Devanshi is here. All right. So, what's up, everyone? How is life going on? How was the weekend, by the way? Did you people get a chance to revise the stuff, go through the questions and go through the questions, people? Ishwari, good afternoon. Barish, okay. Come on, you answer my first question first. People, did you get a chance to go through the things or not? And where are we done till in the OutScanner? So give me a minute. One second. So what do you say? We have the OutScanner ready. Can we get the soft copy of OutScanner used in the class? Okay, I will upload it, Jahan. Sai, till question 9, we have to start from question number 10. Okay. Ishwari, you got the printout of OutNotes? Alright. Gauri, revise the concept. Chandana, revised. Yes, revised. Oh my god, rest of the people, come on. What are you doing? Did you, people in the class, revised the concepts? What do you say? Or the blankness, or your blank? In the last lecture, I got to know that a lot of you now understand Hindi, right? Miral, yes. Gaurav, yes. Good afternoon, Gaurav. So great. Everyone. Till question number 9th, we are all done. We will now have to slightly speed up. So I hope you guys are set. Question number 10th, let me check. So 10th is there, and after that, cool. Fine. Question number 10th, people, we are not doing. There is a similar question of advanced nature that we will do later on. That question will teach us the things that we are supposed to know. So question number 10th, everyone, we are not doing, not needed. There is other question which will teach us the same thing which question number 10 is trying to teach. Okay. So 10th not needed. 11th is a study material question we will have to learn. So let us everyone right away get started with question number 11 to be done in the class itself. Right. So shall we? Come on. Do we have the energies to get started? What do you say? Soumya, revised. Gaurav, yes. So people, question number 11. So just a reminder, can you people please check your this thing? Can you people please check your emails? You must have received the serial keys and whatever links, the Google Drives and everything. People, make sure you do your all the installations and everything today itself, because tomorrow onwards we'll have the lecture in the content browser. So anyone in the class who has registered at least 2 days back and who has not received the serial keys and everything, you will have to I will check the telegram. It's been quite I know there's a delay of 2-3 days. I'll have to check my telegram as well, right? So I'll share the team of the technical the number of the technical team. You will have to get in touch with them and get your issue resolved. All right. So tomorrow onwards, we'll have to do it on the content browser, everyone. Done? Let's get started. Sir, in December 2011, question number 11, please. In December 2011, AB company's share was sold at rupees 146 per share. The long-term earning growth rate is 7.5. The long-term earning growth rate of 7.5 is anticipated, right? And company is expected to pay dividend of rupees 3.36 per share. Everyone, can we please, I need your attention, can we please look at it and find out the data which is given? Sir, first we have been given the share price. P0 has been given. 7.5 is the growth rate which is given, and expected to pay, which means D1 is also given. All right. Board is not visible. One second. Is it people visible now? Screen is not visible, board is not visible, it must be visible now. Right? Done. Cool. Come on. So at least now I see that you people are not sleeping, right? You are able to identify what is missing. Come back to question number 11. We said we have read the first line, which says company share is being sold at 146. The growth rate is 7.5%, and the dividend is expected to be 3.36, which means D1 has been given, growth rate has been given, and P0 has been given to us. What are you required to calculate? What rate of return an investor can expect to earn, assuming that dividends are expected to grow along with the earnings at the rate of 7.5% per year in perpetuity. Come on, observe. Sir, they are asking you to calculate the rate of return an investor can expect to earn, which means they are asking you to calculate expected rate of return. But as you know, the examiner interchangeably uses the word expected and required, so obviously we will have to calculate the required rate of return, right? But sir, for required, you know the ranking. First is CAPM. Can we apply? The answer is no. Second one is what? Sir, second one is Gordon's model, which is D1 divided by P0 plus G. Do we have the data? Sir, D1 is there, P0 is there, growth is there. But one second, don't be so blind. Everyone, the given growth rate is the growth rate of earnings. If the payout ratio is same, we can assume it to be the growth of dividend, otherwise no. But fortunately, examiner itself has made it clear that dividends are expected to grow along with the earnings at the rate of 7.5, which means G will be 7.5. Everyone in the class, use your calculator, give me the answer to first question. Such a easy question. Come on, answer to first question, please. Answer to the first question. Come on, quick, waiting. Priyanka, answer please. Gopi, Miral, Gauri, Venkat, everyone please answer. So it is 3.36, which is already the D1 divided by 146 plus 0.075. Let us do it right away. 3.36 divided by 146 plus 0.075, which is 9.8%. Everyone, easy, sorted, basic, done. Let me take you to the next part number B over here. People, come on. It is expected that, come on, please pay attention. It is expected that AB company will earn about 10% on book equity. 1 second. AB company will earn about 10% on book equity. Can you please process this line for me? What do you think this line is trying to say? Will earn about 10% on book equity, which means book equity, which means as per the book value of the equity, on the book value of the equity, which is on equity shareholder fund, we will earn 10%, which means, do you realize this is nothing but ROE given to us? Because return on equity is what a ratio based on book equity is. Okay. And it shall retain 60% of its earning. 1 second. If ROE has been given to us, if the retention ratio has been given to us, using the two things, what can we calculate? Everyone in the class, let me take you back to the OutNotes. Come on. Do you remember the discussion of retention ratio into ROE is nothing but the growth rate of earnings? And if examiner silent will assume to be same as the growth rate of dividend, sir, retention ratio 60, ROE 10%. Can you tell me how much turns out to be the growth rate, everyone? So 60% into 10%, everyone, is 6% of people in the class. 6% of growth rate, the revised growth rate. But the older growth rate was 7%. Okay. In this case, whether there would be any change in the growth rate, obviously yes, it will now be 6%. But will there be any change in the cost of equity? Again, cost of equity, which formula are we using? Sir, we are using D1 divided by P0 plus G. So, sir, obviously the growth rate rather than 7.5 will become 0.06. Sir, the P1 is expected to remain the same. The only catch this particular question has is that, sir, this dividend of 3.36, this dividend of 3.36 which we were expecting, right? This was the dividend based on older retention ratio and the older growth rate. Now my retention ratio as well as the growth rate has changed. So accordingly, I will have to recalculate that if as per the newer retention ratio, what will be the newer dividend, and also giving the effect of newer growth rate. This is the particular catch in this question, people in the class, you should know. Sir, but how do you know the retention ratio has changed? You have nowhere specified. But at least with respect to growth rate, are you understanding? Please observe the point I'm trying to say. Please observe. Sir, let's imagine that previous year or maybe at 0 point, these are the earnings. E0 is my earning at 0 point. Then do you people agree? Do you people agree? Earlier my dividend was growing at the rate of, my earnings of next year were growing at the rate of 7.5%. Right? Of that, even some particular payout ratio was there using which the dividend was 3.36, as I know, right? I will have to check what was the payout ratio. But of this, even now the growth rate first of all will be 6%, and whatever will be my revised even, of that, some particular portion of dividend which is 40% be distributed, and that is how I will get the revised dividend. People, let me take you through the situation again. You'll have to be all there with me. Everyone listen to me, please. Sir, what are you doing? The point I'm trying to tell you is that, do you agree this expected dividend is based on the older estimates of growth and payout? Now the estimates have changed. So in which case, how do you give the effect of it? Please listen to me very carefully. Sir, this is on your timeline. Let's imagine, please don't focus on drawing the things, focus on understanding them. Everyone in the class, don't focus on trying them, try to focus on understanding them. At 0 point when you stand, right, on your timeline, this is 1 year. Sir, the dividend was expected to be 3.36. So let us try to imagine what was the payout ratio earlier. Everyone. Sir, my ROE is given as 10%, right? And the growth rate, everyone, is given as 7.5%. Please listen to me. I have been given my growth rate, right? Which is a multiplication of ROE into ROE into retention ratio, that I know. Sir, growth rate, the older one is 7.5%. Do you agree out of the two numbers available, if I assume any one number, or if I can find out one number, I can have the another number with me. So they have given in the second part that the retention ratio will be 60 and the ROE will be 10, right? Which of these two numbers do you think, right, was also there even in the first part? Now think practically, which of the two numbers is in the hands of company to change? Is it ROE, which the company can change in its hand, or it is primarily the retention ratio which company can change? Everyone in the class, quick. Can I say retention ratio, the dividend policy is in the hands of the company? Here, right? Which means I will have to assume the ROE to be continuing. I'll have to assume the ROE to be continuing as it is as it was there in the previous years. Say, and I will say my ROE was 10% even in the previous years. So if ROE is 10, growth is 7.5%. Can you tell me how much would be the retention ratio? How much would have been the retention ratio? Come on, quick, I need your validation. So 7.5 divided by 10, if you solve this, the retention ratio turns out to be 75%, which means the initial payout was 25%. 75% was the retention, 25 was the payout. So now listen to me. If I have the existing, right, at present, when I stand, my dividend is 3.36. From this dividend, can I back calculate the existing even that will have even, right, the earnings we will have next year? Yes, sir. For that, you'll have to divide it with the payout ratio of 25%, as we have calculated the existing payout, because 40% is the revised payout. Correct. So, sir, 3.36 is divided by 25% will give me, on your calci everyone please, existing even, the expected earnings of next year as 13.44. Sir, that was the expected earning provided the growth rate was older growth rate of 7.5%. But do you agree now, since the growth rate is changing to 6%, the expected even should accordingly change? So can you people in the class, can you please people in the class, 13.44 is the earnings after the growth rate. So can I eliminate the effect of growth rate and find out E0? Answer is yes. 13.44 divided by 1.075. Eliminating the effect of growth rate. How do you calculate even? Please feel. E0 into 1 plus G is equals to even, right? If even of 13.44 I have, can I divide it by 1 plus G to find out E0? So can you everyone in the class tell me the amount of earnings at 0 point? People, 13.44 divided by 1.075 gives me 12.50 on a rounded off basis, the amount of earnings at 0.0. Today is the earning. Do you realize now next year my earnings will be revised due to all these changes, and my revised earnings everyone will be 12.50 plus 6% of revised growth rate will give me revised estimate of even. So 12.50 everyone plus 6% is 13.25 revised even. Come on everyone in the class, are you till this point settled or not? Are you people till this point settled or not? Quick. All the live people in the session, what do you say? Sai, yes. Others in the class, are you please able to connect to my thoughts? Gauri, are you able to connect? Yes, Sai. So literally, all of you people have complete freedom at any point if you feel that, sir, I am not able to follow or I could not understand what was going on. Provided you were giving your 100% in the class, you have all your rights to ask me as many times as you want. That, sir, I didn't get this particular point. How did you do it? Or what is the underlying logic? Don't even slightly hesitate to ask any doubt that you want to ask. If you're not able to frame the doubt in English, it's fine even if you ask the doubts in Hindi. It's all fine, all fine. But no compromise in learning. So, sir, now I have the revised earnings of 13.25. Everyone in the class, do you agree? Of this revised E1, I will distribute now 40% as per my revised policy. So, sir, 13.25 into 40% is 5.3 rupees of dividend to be distributed. Which means, do you realize what was the thought process? I knew it is D1 divided by P0 plus G. Sir, G is 6%. P0 is 146, I know. But due to change in retention ratio and due to change in growth rates, my D1 was supposed to be recalculated. So first I had to go back to E0 and then back calculate, then again calculate revised D1. Yes. So now if you have all the numbers, sir, 5.3 divided by 146 plus 0.06, how much it turns out to be? 5.3 divided by 146 0.06 is 9.63. People in the class, 9.630 on a rounded off basis, the answer of KE. Requesting your responses. Are you settled with question number 11, please? Quick. Yes. Done. So question number 11, we are all set. I'll be sharing this annotated OutScanner PDF with you people on the channel, as in on the Google Drive folder. Okay, there you can refer this PDF. Okay, and update whatever you feel like updating. Done. We are proceeding everyone in the class to the next one. Question number 12, extremely easy question, at your own, only on Calci. At your own, only on Calci. Question number 12, extremely easy. Question number 13th, simple question, easy question, only two things you should know. Only two things you should know. First, sir, we have to prepare the income statement. So we anyways know the entire format of income statement. But sir, we have to have the sales, right? So if you look at the data given, we have the total assets given to us and the asset to turnover ratio given to us. Does anyone in the class know the formula of asset to turnover ratio? Come on, people, please. Anyone in the class, formula of asset turnover ratio? So let me tell you, in your OutNotes on page number 8, we have tried to compile all the formulas and all the ratios, especially formulas related to ratios used in the course. In any question, if you have any formula which you think you should know or which should you be able to revise one day before the exam, we will write it down here on page number 4. If that would be not sufficient, we'll take it obviously to the next page, right? So for example, the first one is asset turnover ratio, which is sales, which is your revenue, divided by average assets. If the average assets are not available, you take the closing assets, right? So simple logic, relative to my asset, how many times is my sales is the simple point of this ratio. Done. So if it is 3 times, it means that if the assets are 500 crore, the sale will be 1500 crore simply. Done. This particular ratio is to be used everyone in the question. So if I have total asset and if I have asset to turnover ratio, what will I have? I will have the amount of sale. Then using operating, see, it is a homework question, but I'm just trying to give you the hints. Manageable, extremely easy question. Now, if you have sale and if you have the operating margin, you can directly calculate that of the amount of sale. If 10% is my operating profit, operating margin, operating profit, EBIT is 10%, which means 90% will be my expenses, right? One point of specific learning is that, sir, I have been given the debt. Two debt, one debenture and one bonds are given having different interest rates. But please realize that the rate of interest will be charged using the effective interest rate. You'll obviously know the concept of that amortization table you draw in FR, right? Which number goes as an expense in the income statement? The amount of coupon or the amount of effective interest rate? Come on, FR people. It is the amount of effective interest rate at which the interest in the income statement is charged, right? So using this rate on this amount, we will charge the interest rate. Okay, so that is one more thing. Other than that, the question is super duper easy. Done. So question number 13th, people in the class, is homework, manageable homework, nothing to worry about at all. Question number 14th is an extremely ambiguous question. Let me figure out if there is a need to solve this question or not. So hold on for a minute. So hold on, let's do one thing. Question number 14 we'll figure out later on if we should do it or not. We are now moving to question number 15th, not to be done. Question number 15th, not to be done. We are now moving to the next concept, because only after learning the next concept we will be able to do questions from 16 and onwards. People in the class, so just to give you a background, 15th not to be done, and a very old question of, I think a question which was asked 20 years back now, okay, not needed to be done. Question number 14th we will figure out later on if is required to be done or not. Question number 13th, everyone is homework, you will have to do at your own, right? 12th only on calci homework, extremely easy, right? 11th we have done. Great, fine. So let me now take you back to the OutNotes, and everyone in the class, you all need to understand the next concept, learn the next concept, which is the concept of variable growth model. How many of you remember that we had two possibilities? Either the holding period was definite or the holding period was indefinite, in which case I had to apply the dividend discount model. If you apply, people in the class, dividend discount model, then let me tell you, one was zero growth, same amount of dividend every year. Another was constant growth, which means the dividends will grow at a constant rate right from first year till infinity. Everyone in the class, the next one is variable growth model. Meaning to say, in this model, initially the dividends will grow at a different rate. Maybe the growth of first year is 5%, second is 7, third is 8, and fifth is 9. But yeah, that is for sure that after a point, till infinity, dividend will continue to grow at a constant rate, maybe a 5% constant rate till infinity forever. If this is a structure of dividend where initially we have some other rate and the later on a constant rate, it is called as variable growth model. Sir, but why was a need to create a separate model? Please think. If the growth rate is not constant in the initial year, can I stand at 0.0? Can I stand at 0.0 and apply Gordon's model at this point? Can I do the present value of my future dividends using Gordon? Everyone in the class, I need your involvement and interaction. Tell me, is it possible to apply Gordon's even if the growth rates are different every year? The answer is no. Because ultimate logic, come on, live people respond, waiting. What do you say? The answer is no, right? But do you people agree that the ultimate logic of valuation is present value of future cash flows? Which means, let me tell you, let us try to, everyone in the class, imagine the stuff. Right? Sir, let's say that at 0 point, the dividend was rupees 100. Cool. Let me give you an illustration. At 0 point, the dividend was rupees 100. The question says that for the first year, the growth rate in the dividend will be 10%. For the second year, it will be 9. For the third year, it will be 9. For fourth year, it will be 8. And fifth year and onwards, it will be 7% growth rate forever. Done. If there is any student in the class, who's lagging behind, I would request you to drag it to the latest point so that you can continue to communicate. Done. People, please look at this. People, please look at this. Sir, that is how my growth rate of dividend has been given. Please have your calcs in hand. People, if the dividend of 0 point is 100, what will be the dividend of his first year? 100 plus 10%, 110. How much will be the dividend of next year? Plus 9%, which is 119.9. Sir, fourth year, sorry, this is second year, plus third year, again plus 9%, which is 130.69. Dividend of fourth year, sir, 130, what was on my calci? 1 second. 100 plus 10% plus 9%. 130 plus 691 or something on there on my calci plus 8% will be the dividend of fourth year 141.145, which is 16. Sorry, 141.146, which is 141.15. Done. For the fifth year, everyone in the class, dividend is again plus 7% is 151.03 on the rounded off basis, and then further 7%. Similarly, this way till infinity. My first question is valuation. We will understand later on. I need a response from every student in the class. Are you people able to connect to the cash flows, the series of cash flows? Valuation we will do later on. Come on. I need a response, everyone. Are you people able to connect to the series of cash flows that, okay, this is how the cash flow will look like? Chandana, answer is yes. Vaibhav, okay, cool. Sai? Priyanka, Gauri, Jahan, Venkat? Soumya? Soumya, dividend growth model is a generalized word used for all three models. In that model specifically, which one to use, that is your wisdom. Okay. Priyanka, if you don't have stable dividend growth even after a point, then you can never do the valuation is the point. Because do you agree? See, if till infinity the dividend if expected to grow randomly, first of all, practically that is not. Ultimately, do you realize these dividend growth rates you are estimating? So will you be able to really estimate that, okay, in 30th year the growth rate will be 8%, but in 31st year it will be 9%, then for 32 year it will be 6%? The answer is no. You can't even predict. One can, with confidence, cannot even predict what will happen after 5 years. The real world is so dynamic, right? So first, that is the thing. Second, practically you think if the dividends are growing at a fluctuating rate, can you discount them manually till infinity? Answer is no. We are able to discount them only using through statistics concept, like this concept. This formula, if you realize, is a, it took its birth from statistics. So for statistics to work, you have to have a constant growth rate till infinity, right? So that is how the cash flows are. People in the class, now you all pay attention to what I explain. Now you people tell me, sir, at 0 point I need to value the bond. Where do I stand? Ultimately, I need to value the share. At this point I stand. Which means the fundamental rule of valuation is that present value of all these future cash flows till infinity is the value of share for me. But the question is, how do I do the present value? Because one way we have learned is Gordon's, which cannot be applied at this point, which is why I feel now sad. So is there any other way? If you cannot apply Gordon's here, do you agree you have at least some point after which the growth rate look constant to you? As I see on the table that fifth year and onwards is a constant growth rate till infinity, can I go to that point and apply Gordon's over there, everyone? Can I do D1 divided by, or whatever is the dividend of that year, divided by K minus G in that year, to at least calculate the present value of future cash flows after that point? Everyone in the class, come on, quick. Come on, quick. So on the basis of given data to me, on the basis of given data to me, can I say, on the basis of given data, can you please tell me at the end of which year when you stand, listen to my question carefully, at the end of which year if I stand and look at the future, I will be able to see only a single growth rate of 7%? Tell me, where do you think should I stand and apply Gordon's? Come on. At the end of which year, if I stand and look at the future, I will be able to see a single growth rate of my dividends so that I am able to apply the Gordons. Come on. Sir, on the basis of table, it looks to me, sir, year 5. But that is what people in the class catches. That is what people in the class catches. If I don't create the timeline now, you will, even a lot of you will get confused that sir table says 5th year and onwards. But please realize, when I say growth of 5th year and onwards, the growth starts after 4th year only. The growth of 5th year, where do I start? Where does it start? From 4 to 5, right? It is a growth number, starts from one point, goes till another point, which is why when you draw it on the timeline, you realize that, okay, at the end of 4th year, when I stand and look at the future, I will be able to see only a single growth rate of 7%. So do you people agree that I can apply Gordon's formula at the end of 4th year? Because the condition of constant dividend is satisfied, right? So everyone, let us do it. Sir, please tell me common sense. If I calculate intrinsic value at 0 point, or if I calculate the price at 0 point, do you agree my first dividend is D1 and the formula is D1 divided by K minus G? So if I want to apply Gordon's at this point, then do you people agree that to be able to calculate a value at this point, my first dividend should be D5 divided by K minus G? Everyone please quick, yes or no? That is first thing. That is first thing. My second thing, please listen to it. Sir, which all dividends and the value, one second, the value so calculated. This value so calculated, everyone in the class is called as terminal value. Since we are calculating it at the end of 4th year, we will call the terminal value at the end of 4th year. The more important thing is realizing what all does this terminal value include in it. Come on, everyone. Do you remember that D1 divided by K minus G includes the present value of all the future cash flows right from 1 till infinity? D1 divided by K minus G includes the present value of all future dividends right from D1 till D infinity at 0.0. It brings back. Similarly, can I say TV4 similarly will have the present value of all the future cash flows right from 5 till infinity, but the cash flows will be discounted to year 4, everyone. Can I say TV4 will have the present value of all the cash flows from 5 to infinity, which means, can I say D5 to D infinity has been discounted and has been discounted back and are there in this value lying at TV4. Come on, quick, people. So what was my fundamental rule? Present value of future cash flows, right? So in TV4, right from D5 to D infinity, everything is sorted. So let's do one thing. Let us do one thing. I need to bring back everything to 0, right? To calculate the intrinsic value at 0. So let me manually discount 1, 2, 3, 4 and TV4. Sir, why 4? Why 4? Because TV4 does not include D4. It includes the cash flows from D5. So 1, 2, 3, 4 and TV4 is what I will manually discount 2.0 to calculate the value of share. People, are you able to please connect to my thoughts on the timeline? And the discounting rate obviously became. Come on, quick. People in the class, quick, such an easy concept it is. I need everyone's response sitting in the class. And if you really got it, you need to say to me yes or no by liking the video. And if it is no, you'll have to say it in the chat box. Come on. Chandana, yes. Venkat, yes. Soumya, yes. Gauri, Vaibhav. Others in the class, come on, quick. Yes. Everyone else in the class who's sitting, are you comfortable? Which means through this discussion, people, do you realize we can do one more thing? With this discussion, we can also imagine the presentation. So the presentation would be very simple. The presentation would be very simple. What? Sir, first column will be years, which is 1, 2, 3, 4. And you know what? Only a student whose imagination is brilliant would be able to imagine how long should the table go. Everyone, how long should the table go? Sir, I know that there is first dividend, second year, third dividend, fourth dividend. And in the fourth year, there is one more thing, terminal value, which is the table should look like 1, 2, 3, 4, 4. Right? This column you don't draw. This is for your understanding I've drawn. It is at the end of fourth year, you will have the dividend of fourth. At the end of fourth year, you will have the terminal value of 4. How do you calculate the terminal value of fourth year? Don't go on the numbers. Please. Numbers will do in the question. But you need the table like years, cash flow, present value factor, and the discounted cash flow. Please imagine, cash flows will be the dividend of 4 years. The terminal value at the end of fourth year, the present value factors will be 1, 2, 3, 4 and 4. And that's how the DCF, and that's how the total of all future cash flows. Present value of all future cash flows. Question we are going to, but are you able to broadly imagine the format? People in the class, please be quick. Come on. What do you say? And are you people also able to imagine the concept on the timeline? Because that is what we will do a lot of time in the AFM, your imagination. Are you able to imagine that, okay, this TV has everything till 5 to infinity. So that is how you manually discount this particular TV and 1 and 2 and 3 and 4 separately. Yes, if you have this imagination, you are all set to go to a question, right? So let me take you all to the OutScanner, and in that OutScanner, question number 16 is a good question. But an easy one. We will do on the Calci right away. Only on Calci classwork, which means at home you don't have to do it in the notebook. Only on Calci. Such a easy question, question number 16 right away, people. A company has paid a dividend of 2.5 per share last year, D0. The required rate of return is 20%. What will be the market price if there is no growth in dividend? Come on, not more than 3 minutes to the entire question. Sir, 2.5 forever, which is 2.5 divided by KE of 20%. 2.5 divided by 20% is 12.5 rupees as the answer to first part. You people don't give me answer, it is fine for this particular question, because next question I'll need your response. Second, sir, if dividend grows at a constant rate at 5% in perpetuity, what will happen? Extreme easy, D1 divided by K minus G. Right, as planning to first skip this question. Skip, such a easy question. But so that you don't feel that we are skipping a lot of things, for your comfort, I'm making you people do this. Come on. So sir, 2.5 is D0 into what is growth rate? 5% will give me D1 divided by KE of 0.20 minus the growth rate of 0.05. Give me the answer, please. 2.5 plus 5% divided by 0.15 gives me 17.5 as the share price. Extremely easy. Done. Sorted. You don't give me answer. Third part. Sir, if constant dividend for the first 5 years and then grows at a constant rate of 5% in perpetuity. Wow. Please imagine it on the timeline. Constant dividend for the first 5 years. Sir, first, second, third, 4, 5 years, same dividend 2.5. For 6th year, the dividend will grow at the rate of 5%. Please tell me, identify which model. Zero growth, Gordon's model, or variable growth model. This particular thing you need to respond. Everyone in the class, please. This particular thing you need to respond, everyone. Tell me. Waiting. Which model? Come on. Which model? Come on, come on, come on. Sir, at any point, if you feel that the growth rate has changed, at any point, if you feel, sir, the growth rate was 0 and it become 5, it is a variable growth model. If it is a variable growth model, immediately imagine something on the timeline. Immediately. Sir, year 1, 2, 3, 4, 5. Till fifth year, there is 0.000% growth for 5 years, right? As the question says, then the growth rate is constant at the rate of 5%, which means after that 5% growth rate for 6 year, 7 year. My question to you is, at which point, if I stand and look at the future, I'll have only one growth constant rate of 5%, which is that point. In other words, where do I find the TV? 1, 2, 3, 4, 5, 6, 7. Tell me, quick. Where do I find the TV, people? Sir, TV at the end of fifth year. To be able to calculate TV at the end of fifth year, do you realize I will need D6 divided by K minus G? Come on. D6 divided by K minus G. So how will my table look like? Sir, it will be cash flow of 1, 2, 3, 4, fifth year. And the TV of 5, the table will be 1, 2, 3, 4, 5 and 5. But here is a catch. Do you realize if all my dividends are same, dividend of 5 years, if they are same, why do I manually discount them? Can I do the annuity? Can I consider it to be the annuity and apply the annuity factor? If you do it manually, there is no harm. If you do it manually, there is no harm. You can also do it manually, or you can also apply the annuity factor. Sir, how do you calculate the annuity, please? 5% is the rate, 1.05, 1.05 divide equal, sir, 5 times, and then GT is 4.3294. Take it till 3 decimal points. Take it till 3 decimal point, sir. Present value factor, future value factor, and their annuity factors are taken till 3 decimal points by the institute in 90% scenarios. Done. So how much was the annuity factor? 1 second. 1.05 divide equals to 1, 2, 3, 4, 5. To me, 1 second. Discounting rate is where? Sorry, the discounting rate is 20%. My bad. 1.2 divide 1, 2, 3, 4, 5. GT is 2.9906, which is 2.991. The discounting rate, everyone, is 20%. I was taking it by mistake 5%. So discounting rate, the present value annuity factor is 2.991. So same amount of dividend for the next 5 years is 2.5. So please understand how do you have to do it on Calci. Write down this number, round it off, then multiply 2.5 with the rounded off number. So 2.991 into 2.5 is 7.48477 is 48 on a rounded off basis. This is the number. Sir, what about the TV5? Sir, for TV5 I will need D6. How much will be D6? Sir, common sense. D6 will be 2.5 into 1.05 will be D6. 2.5 into 1.05 will be D6, right? So 2.5 into 1.05 is 2.625 divided by K minus G. K, as we know, is 20%, G, as we know, is 5%, so divided by 0.15 is 17.5 rupee of terminal value. What is the factor of fifth year? What is the factor of fifth year? 1.2 divide 1, 2, 3, 4, 5. 5 time equals to 0.4018 on a rounded off basis is 0.402, right? So 17.5 into 0.402 is 7.035, 7.04 on a rounded off basis. 7.04 on a rounded off basis. And answer to this is, everyone, 7.48 plus 7.04 is 14.42 people in the class as the answer to third part. Requesting your responses. Are we all 100% comfortable with this, please? Everyone. Such a easy question, such a easy question. And part number D is homework. Part number D is homework. Sir, constant dividend for the first 5 years, which is 2.5 similarly for the first 5 years. And at the end of fifth year, it is 20 rupee of selling price. So it is so simple. Sir, for the first 5 years, same dividend, same present value factor, same cash flow. At the end of fifth year, sell it for 20, discounted by 0.402, whatever is the number is the answer. Done. Done. Question number 16th gets done. 17th, extremely easy question. So it was only on Calci. When you go home, don't do it on notebook. 17th question, similar nature, easy question, homework. Because a difficult level question we will do right away in the class, which is question number 18th. People in the class. Question number 18th, right away. Right away. Come on. One thing for which I particularly need your validation is, are you able to cope up with the speed of the class? Quick. Come on. Come on, come on, come on. So I need a response. Who all do I have in the class? Usha Rani? Yes. Priyanka? Yes. Chandana? Sai? Gauri? Come on, others in the class, quick. Vaibhav? Soumya? Other students in the class, please. Venkat? Ishwari? Cool. Jahan? Live are so many people. Prachi? Done. Okay. Abdul and Zaba. Great. So you know people what? You have to believe in the process that at any point, whatever I feel is needed to be taught, I will teach you. And whatever I feel that, sir, this is something you can do it at home, we will keep it as homework. Okay. For example, I felt that this entire question is easy. But these are the 2 points where you might face any difficulty in this question when we discussed, right? So the entire question as a whole was homework. But those tricky points I explained immediately so that you don't struggle at home. Similarly, where I feel that you will be able to manage it, we end up saving the time in the class, right? For example, 17th question. Easiest question. Similarly, we are proceeding for 18th question. Sir, XYZ Limited paid a dividend of rupees 2 for the current year. Has paid a dividend. Okay, D0. The dividend is expected to grow at the rate of 40% for the next 5 years. So quickly imagine it on the timeline, 40, 40, 40, 40, 40, done. And at the rate of 15% thereafter, done. The return on 182-day treasury bill is 11% per annum, is basically your RF. Market rate of return is 18%, is basically RM, and the variance is 24%. Variance of RM. So variance of market is 24%. Sir, what is this? If you are able to process it, it's fine. If you are able to not process it, leave it for later, because portfolio management has this concept. Such a easy concept, I am sure you would know what it is, right? The covariance between the return of market and that of a security. So covariance with the return of security and market is 30%. You are required to calculate the required rate of return in the intrinsic value. People, required rate of return means applying CAPM being the first priority. I have RM with me, I have RF with me. Can I have the beta? The answer is yes. In the portfolio management, you will learn the formula of beta to be covariance between security and market divided by variance of market. I'm not explaining it right now. I'm sure most of you would know it. If you don't worry. Sir, covariance between security and market is 30 and variance of market is 24. So 30 divided by 24 is 1.25 of beta. People, you have the beta with you, you have the RM with you, you have the RF with you. Let us do CAPM right away. Give me the required rate of return, CAPM please. Give me the required rate of return, CAPM please. Come on. Quick, CAPM. So beta plus RF plus beta into RM minus RF. So 18 minus 11 into 1.25 plus 11 is 19.75 people in the class, the calculation of KE. Right? Easy, done. Sir, now the value of the stock. Which model? Immediately. Which models are obviously variable growth? Terminal value will be at which point? My next question. Terminal value, everyone in the class, will be at which point? Sir, obviously at the end of 5th year. Now my next question. How will the table look like? 1, 2, 3, 3, 1, 2, 3, 4, 4, 1, 2, 3, 4, 5, 5, 1, 2, 3, 4, 5, 6, 6. How will the table look like? My last question, and then we are set. Come on, quick. People. How will the table look like? One, two, three, four, five, five. In the presentation as well, we should be equally smart. 1, 2, 3, 4, 5, 5. Done? Great. Sir, now how do we grow our dividend? Let me now teach that to you. Everyone in the class, please listen to this conversation, this discussion carefully. Sir, the presentation is 1, 2, 3, 4, 5, and obviously the 5th year again. People listen to it. Sir, dividend is 2 dividend has been paid as 0. 2 dividend at 0.0. Sir, dividend of first year is 2 plus 40%, right? So there are two ways to do it. 2 on your calci plus 40% is 2.8. Another way to do it is that, sir, you take 1.4 on your calculator. Sir, 1.4 is basically adding 40% multiplied by 2. I'm not saying 2 multiplied by 1.4, you will have to take 1.4 multiplied by 2. When you do so, every time you press equal to, the growth rate automatically gets added. So you'll have to do 1.4 into 2. Now, when you press equal, automatically the effect of 1.4 keeps on happening every year. Automatically the 40% keeps on adding every year. So first year it is 2.8. Again equal to on my calci is 3.92. Again equal to on my calci. Now listen to me. Again pressing equal to is 5.488. I'll take it 5.49. Are you people settled till 5.49? Because now I will tell you something else beyond it. Come on, quick. 5.49 on my calci, please. 5.49 in my notebook. On calci it is 5.488. Come on, quick. I need to teach you something important with respect to presentation. We need to learn how do we need to avoid the rounding of errors. Done. Now listen to me. Sir, the next number can be two possibilities. Either I take 5.49 on my calci. Please. Either I take 5.49 on my calci and to that number I add a growth rate of 40%. Second choice, I continue with the same number which is there on my calci, which is 5.488. What do you have to do? Continue with the same number on your calci. Don't add the growth rate on 5.49. Rather continue to add it on 5.488. Right? One second, Rajveer. One second. I'll come back to you. So that is how it is. So on my calci it is 5.488. If I press equal to, again it is 7.6832, which is only 7.68. If I press equal to, again it is 10.756, which is 10.76 is the dividend of 5th year, and I need the dividend of 6th year, right? If you press equal to, again, sorry, obviously not equal to, because now the growth rate is 15%. So 10.76 On your calci, multiplied by 1.15 being the 15% growth, whatever is the number will be D6 divided by KE of 19.75 minus the forever growth rate of 15%. Give me the answer of terminal value waiting, everyone. Could you understand that presentation part I was trying to teach to you? How do you do the rounding off of dividends? Everyone, please. Could you understand that specific part? Rajveer, awesome teaching, sir. Just completed 90% foster batch. मज़ा आ गया, इतनी ज़्यादा कॉन्सेप्चुअल क्लैरिटी. पहले क्वेश्चन के पीछे भागते थे, अब क्वेश्चन पहले माइंड में सॉल्व होता है फिर कॉपी पे. वाओ, what a brilliant feedback. So those people who don't understand Hindi, he's trying to say that amazing class, just completed 90% of it. Earlier we used to run behind the question, solving it in the notebook, running behind getting the answer. The approach has now been changed. Please listen to me, that is one of the objectives you should learn. We should now never be running behind the answers, but rather running behind the concept which the question is trying to teach to us. Right? And that is what the approach should be. Because every question will have one thing in its, one uniqueness in it, right? One unique thing which will help you to learn something, learn a particular concept hidden in that question. Once you do that, the answer will automatically be a byproduct. And anyways, we continue to do so even in the class, right? So come on, you need to answer me first thing. Did I explain to you how did I take these numbers of dividend in the notebook? Come on, quick. Come on, quick, everyone in the class. Quick, people. And if yes, answer to me with the number of terminal value. Soumya, in short, once more, I will do it right away. Everyone, this is needed once, no problem. Soumya, on your calci you take 1.4, which is 1 plus growth rate. Come on, Soumya. 1.4 multiplied by your 0-year dividend of 2. Now you just have to press equal to and take the rounded off numbers in the notebook. That's all you have to do. First equal to is 2.8. Second equal to is 3.92. Third equal to is 4.488, which is 5.488, which is 5.49. Fourth equal to is 7.6832, which is 7.68. Fifth equal to is 10.756, which is 10.76. Could I please explain to you, Soumya, and everyone in the class who could not understand it? Till 5th year you do this, but for 6th year obviously the growth rate has changed, so it will be 10.76 plus the 15% divided by K minus G. I need an answer of intrinsic value, everyone sitting in the class, please. Come on, quick. Answer of intrinsic value, everyone sitting in the class. Sorry, first terminal value. Sir, 10.76 multiplied by 1.15 divided by 19.75 minus 15 is 4.75, so 0.0475, right? 260.51 on a rounded off basis, people. 260.51 on a rounded off basis is the answer of intrinsic value. Is it turning out to be? What are you people saying? 105? Come on. Abdul, Yash. What are you giving me the answer of 122? Acha, the final value. But 105, you're not supposed to give me the present value of terminal value. I asked only the terminal value. A further present value will do later on. So one second. Usha Rani, Vaibhav, Ishwari, Venkat, Gauri, Chandana, people, Sai Prashant, Priyanka, do you people really want me to make you a video call right away and scold you upfront for not responding at all? What are you doing? Vaibhav, a small teaching, a small learning for you. Rather than rounding off this dividend, it is better now to not round it off. Take it 10.76 into 1.15 and let us solve the entire number on the calci itself and then finally round off the terminal value only. Don't round off the dividend. Did you understand me? Then Yash, you will have to observe this particular thing carefully. Yash, if it is 260.50526 on your calculator, if it is 260.50526 on your calculator, Yash, it has to be 260.51. For rounding off, if the examiner deducts the mark, then he is right at his place, let me tell you. Right? The next one. Sir, if I have the dividends, let me do the discounting this time. Sir, let me write down the present value factor at the rate of 19.75. Let me write down the factors manually and then I will do the DCF. Sir, 1.1975 divide equals to is 0.835 first year equal to 0.697 second year, 0.8523 which is 8.2, 0.486 fifth is 0.406 and again 406. Done. Even the present value factors are fine. Now this number into this number is here m plus. This number into this number is here m plus. This into this here m plus and so on. Let's do it. 2.8 on your calci multiplied by 0.835 m plus. Sir, 3.92 on my calci into 0.697 m plus, 5.49 on my calci 0.582 m plus. Sir, 7.68 on my calci into 0.486 m plus, 10.76 into 0.406 m plus, 260.51 into 0.406 m plus. Memory recollect is 122.133, which is 122.13 on a rounded off basis is the answer, people. 122.13 on a rounded off basis. On my calci it is 122.13352 something. 18th question, variable growth model, basic question, complete comfort do you people have? Because I need to now take you to the advanced level questions which I've been really waiting for. Do you have the energies, the excitement to go to the next one, people? Some advanced level question as we proceed. Let me take you to the 19th question first. To the 19th question. All right, people in the class, come on, quick. Sir, an investor is considering to purchase the equity share of LX. We said fine, cool. Whose current market price is 112. The market price has also been given right now 112. Okay, the company is proposing a dividend of rupees 4 for the next year. Sir, D1 is going to be 4 rupees. Fine. LX is expected to grow 20% per annum for the next 4 years. One second. LX is expected to grow at the rate of 20% for the next 4 years, which means, is it the growth rate of 1, 2, 3 or 4? Or since dividend of first year is already given, therefore it is the growth rate of second, third, fourth and fifth. Did you, everyone in the class, did you get my question? Sir, dividend of first year has already been given 4. So the growth rate for the next 4 years, people, is it the growth rate of 1, 2, 3, 4 or 2, 3, 4, 5? Even I don't know. I will make sure that the question is completely transparent to you. I will not hide such things. Come on. Okay, so we don't know. Hold on. The growth rate will decline linearly from 16% per annum after the first 4 years. Sir, after the first 4 years, which means year 1 and 2 and 3 and 4, after the first 4 year, the growth rate will decline, which means the given growth rate was growth of 1, 2, 3 and 4 year only. Did you realize the question I raised and the solution I gave to it? Everyone in the class, please. It is 20, 20, 20, 20. But sir, one second. But first year dividend of 4 has already been given. Yes, which means the growth effect of 20% is already included in it, is the point you need to know. 20%, which is the growth of first year, is already included in it. Did you understand, everyone? That is what I'm trying to say. Settled? Are we? Is that please fine? Yes, cool. That is not an indirect info sign. They didn't even realize that their language is confusing. We purposefully found out an unclear language, and tried to sort it out. For them, they didn't even realize, the examiner, that the question has a mess. Anyways, sir, but the growth will decline linearly to 16%. Do you understand what does the word linear mean? Sir, if the growth rate is right now 20, linear means same amount every year. It can be 2% every year, like 18 and then 16, or it can be 1% in every year, 20, 19, 18, 17, 16, or it can be 1.5% every year, but that is what the word linear mean. So it will linearly decline to 16% per annum after the first 4 years. But the question didn't specify how much percentage every year. We don't know. Okay. Thereafter, it will stabilize at the 16% per annum till infinity. Sir, once it decline linearly every year, it will come to 16, and at that 16% the growth will continue to be there forever, which means that forever growth rate is 16% indefinitely. Sir, the investor requires a rate of return of 20%, which means K is 20%. You are required to calculate the intrinsic value of the stock. I need to calculate intrinsic value, for which I need to draw a timeline. On the timeline, the problem is that I have the dividend of 4, I have the growth rate of 1, 2, 3 and 4, but after that, how should the decline happen, that I don't know. Should the linear decline be 1%, 2%, 0.5%, what percent, that we don't know. What do you think we should do? My question to you all, people. I'm not expecting you all to answer my question, but I'm expecting to understand my question. Did you understand it? People, what do you say? Everyone in the class, come on, quick. And let me tell you, whenever you think that some particular information is missing in the question, a lot of time the present value factors are going to help you in this. Sir, let us make our first assumption, the most natural assumption of 1% every year. Let us make sure that we follow the growth rate 1% every year, and let us check if the present value data is matching with the required. For example, if first 4 year 20%, then fifth year will be 19, sixth year growth will be 18, seventh year growth will be 17, eighth year will be 16%. People, thereafter, after the first 4 year, it will linearly decline to 16. But how much every year? Sir, let us assume 1% every year, 19, 18, 17, 16, and then continue to remain 16 forever. Sir, in this entire story, where do you think I can calculate TV? Shri Vidya, Usharani, Soumya, Vaibhav, Sai, Gauri, all the people in the class. Prachi, are you there listening to me? Priyanka, please. Yash, Abdul, what is happening? Tell me. Venkat, Devanshi, are you people there? Gaurav, are you people there? At the end of which point do you think, if I stand and calculate the terminal value, I can? Seventh. Which means, can you please imagine how would the table look like? 1, 2, 3, 4, 5, 6, 7, and again 7. And on the basis of table, can you people tell me, I need the present value factors for how many years? Sir, till 7. How many have been given? Till 7. Hence your assumption is correct. Did you? Everyone in the class understand the ambiguity of this question, and did you at the same time realize how did we find the solution? If the table was supposed to look like 1 to 7 and then 7, that is how the present value factor till 7 has been given, and the question now is easy. Am I? Everyone in the class clear on this, please? What do you say? See. One second. The objective of this discussion was not to teach you the solution, but rather to teach you how should you be able to imagine a question. Now, once everything is sorted down, obviously the solution is not difficult, right? I'll have to simply add different growth rates to different dividend and ultimately calculate the terminal value, right? Right? Let us make this question a homework question and similar nature modified question. Let me do it in the classwork. People, please. So let me tell you everyone, what institute does is that institute has a habit of modifying the question, right? 19th question was a question asked in May 19 and November 20. In the attempt of May 23, institute modified the above question and asked this question in the exam, right? To be frank, I feel giving this question as a homework challenge, but it is better we do it in the class right now, and I give it to you as classwork challenge. People, let's do it. An investor is considering repurchasing equity share of Alpha, whose current market price is 172. Fine. Current market price 172. The company is proposing a dividend of 6 for the next year, which is 31st March 24. First year dividend has been given as 6. Alpha is expected to grow 20% for the next 4 year. Again the same story. For the next 4 year, the growth is included. Thereafter, the growth over the next 3 years will decline linearly by 100 basis point per annum. This time the ambiguity got removed. People, there is a decline of 100 basis points every year. Sir, 100 basis point is equals to 1%. Just like 1 rupiah has 100 paisa, 1% is 100 basis point. So decline of 1% over the next 3 years is the ambiguity removed. So please imagine timeline. Sir, next 4 years, 20%, so 2020, 2020, then 1% decline every year, 19, 18, 17, the decline happened, right? Thereafter, the growth over will decline linearly. Thereafter, it will stabilize at a certain growth rate per annum. After the 3 decline, there will be some particular growth rate we don't know. There is some particular growth rate we don't know, but at this growth rate, the growth will stabilize, which means there will be then a stable growth rate, constant growth rate every year till infinity is what the question is trying to say. How much we don't know, don't compulsorily assume 16. There is some certain growth rate, maybe of 15 or 14 or 16, whatever, at which the dividend will grow consistently till the end. Okay. Required rate of return is 20%. Dividend value to be taken only till 2 decimal points. You are required to calculate the stable growth rate of alpha at the end of 7 years. Sir, after 7 years, right? After the end of 7 years, what is that stable growth rate we need to find? But sir, one second. In the OutNotes, you have taught only one way to calculate growth rate, which is ROE into the retention ratio. Only two things. ROE multiplied by the retention ratio. Only two things. Like this is the only way you have taught to us to calculate the growth rate. But the question doesn't follow in the same flow. We don't have the retention ratio. We don't have the retention ratio. We don't have the ROE. So please, this time you learn one more thing applicable to the entire AFM again. People, I need your energies in the class. Please listen to me. Whenever examiner asks you for something which cannot be directly calculated, then obviously plan B is some kind of back calculation. Try to think, what is this growth? What is this calculation about? What is this entire question about, the valuation? So has the final value already been given to you? The answer is yes, 172.45, which is why I say, which means use that given number and try to back calculate. Try to back calculate this growth. Sir, is it really possible? Let us try to imagine, everyone in the class, please. Sir, I have to manually discount this, and also the TV7. Do you people agree I'll have to calculate TV7 because a constant growth rate afterwards? What will be TV7? TV7 will be based on D8. D8 basically D7 into 1 plus G divided by K minus G. I have the dividends of first 7 years, there is no doubt in it. I have the dividends of first 7 years, no doubt, right? Sir, TV7 is not available because that make use of the growth rate which is not available. So do you agree present value of all these numbers and the present value of TV, all that should be equal to 172.45 people in the class requesting your responses? What did I say? Present value of all these dividends and the terminal value at the end of 7th year. Present value of all these numbers, should it be equal to 172.45? Are you able to imagine the question with me, please? We don't have to run to get the solution. That is a byproduct. In any future question, if you see this concept, will you able to will you be able to apply your knowledge to it? Tell me that, people, please. Answer, you will obviously get to this question. Come on. Come on, come on, come on, quick. Yes. So let us try to do it. Sir, let us try to plan the solution. Let's see that we don't know the solution. Let's see how do we do it. Come on. Sir, let's do one thing. Can I first of all manually discount all of them and get a number? And then I discount this and get a number and then frame an equation? Which means rather than doing it entirely in a single, because this time the table will look awkward. We can't create a table this time. We don't have the number of TV. It is rather an equation. So we'll have to do it in a formula driven manner, in a single line. In which case, let us manually discount all this cash flow in a table and then I make an equation. Done? Deal? Come on, quick. Sir, on your calculators, the amount of dividend, please. On your calculators, the amount of dividend, please. People. So as I said, 1.2 on my calculator multiplied by the dividend of 6 which is already D1. Dividend of 6 which is already D1. Come on. Which is already D1. Alright. Then, sir, equal to 7.2 second year, equal to is 8.64 and equal to is 10.368 which is 10.37 for 4th year. Whatever number on your calci you have plus 19% is 12.337 is 12.34. Whatever number on your calculator plus 18%, 14.558 is 14.56 plus 17% is 17.03. All these are the dividends, everyone in the class. Dividends multiplied by the present value factor. If we take it till 3. If examiner gives it to me, if we take it till 3. If the examiner gives it to me, it is till 4. All fine. Multiplying this into this will be the DCF, everyone in the class. Let us do right away. First 4 are super easy. Growing at the rate of 20, discounting them at the rate of 20, the unrounded off answer should obviously be 5. Still do it. Do all the calculation and give me the present value of dividends of the next 7 years waiting in the class. People. Present value of dividend of next 7 years waiting in the class, everyone, please. Quick. Waiting. 34.59, that is what people are saying on a rounded off basis. That should be everyone. You're not allowed to make the rounding off mistakes. 34.59. All right, everyone, great. Now, sir, what would be the PV of terminal value? So let us first of all think what will be terminal value. I have D7 available with me. If I want to calculate TV7, I need D8, which is nothing but D7 into 1 plus G. So it is like D7 of 17.03 as I have into 1 plus G divided by KE of 20% minus G. This is TV7, and that is also to be discounted at this discounting rate of 7th year, so that I get the PV of terminal value. Done. Now, I know that the price is PV of dividend plus the PV of terminal value, right? Please observe it in the OutNotes. Please observe it. Terminal value at 0 point, price at 0 point or intrinsic value at 0 point is the present value of the dividend still n, and also the terminal value at the end of nth year only, right? So the same thought process, if we apply, everyone in the class, we have the numbers, right? 172.45 is the given price. That is equals to present value of dividend of 13.59 as you have calculated, plus this given entire present value like this. Everyone, shall we try to solve it? Shall we try to solve it? And let me now try to teach you one more thing. Should I try this one? Yes, give me a second, let me try. Yes, on my calci, it is 17.0337. 0337, that is how it is, yes, to me on my calci. Okay, simply without rounding off, adding these growth rates till 17 gives me 17.03, just for information. Yes, let me now, everyone in the class, try to teach you how do you solve it on the calci. First of all, 34.59. Can I bring this number towards, listen to me, please listen to me. I'm trying to teach you something on the calci. Can I say this particular numbers when I bring towards the left? It is 172.45 minus 34.59, everyone. Done. On my calci, it is 137.86. Now next level. Do you agree that this particular number which is in the numerator can be brought here in the denominator, and this particular number which is in the numerator can also be brought here in the denominator over here? These two numbers can be brought here. So 137.86 on your calculator divide by people 17.03 divided by 0.2791 is everyone 29.00 something. 29.00. So ultimately the conclusion is 29.00 is equals to 1 plus g divided by 0.2 minus g. 29.00 is equals to 1 plus g divided by 0.2 minus g. This is the simplified equation left after you do these things on the calci. In this class, you people will also learn how to do the things entirely on the calci. It will save up your time. Right, this much we are settled. Usha Rani, I'll repeat this step again. Everyone in the class. Sir, 134.59 as is there, plus something is there. So do you agree 34.59 I can bring to the left and deduct it? So I will have some number on the calci which will be equal to this entire part. Right. So 172.45 minus 34.59. Now please realize Usha Rani, in the RHS 17.03 and 0.2791 are in the numerator in the RHS. So can I bring it down towards the left in the LHS but in the denominator? So dividing it by 17.03 divided by 0.2791 gives me 29.00 something. And that is equal to only this much of a part, which is 1 plus g divided by 0.2 minus g. Please, now you can simplify this. Let me take the entire thing here and multiply with the 29 and then solve it. People. So basically 29 into 0.2 minus 29 into g is equals to 1 plus g is what I'm expecting. Solve it, please. 29 into 0.2 is 5.8 minus 29g is equals to 1 plus g. Solve it off. So g when goes that side, it becomes 30g is equals to 5.8 minus 1 is 4.8. So 4.8, everyone in the class, divided by 30 is 0.16, which is 16% of stable growth rate forever, which the institute is asking for. Did you people in the class got the answer? 16% of everyone who all got the answer, please give me this feedback in the chat box. Whosoever get the answer of 16%, say yes in the chat box, say hooray in the chat box. Usha Rani, yes. Sai, yes. Gopi, yes. Gauri, yes. Come on, others, please. Soumya, Chandana. Hooray. The third step is also start to jump at your place. Jahan, yes, got the answer. Great. So question number 19th and 20 both gets done. 21st, again, a good level question I'm going to do right away in the class. But for that, I want to give you a break first. So people, kindly have a very quick 45-second break, post which we will start question number 21. Oh, 45 seconds. Don't look at the time. Else 45 seconds will be more pressureful than the actual question. Okay. So breathe in. Breathe in for this brilliant question. Question number 21 we are going to do. People, strategic timeout. Sai. Breathe in for this brilliant question. Question number 21 that we are going to do in the class. Come on, people in the class, please. Come on. This question is going to teach you so many things that you can't even imagine. People, let's proceed. 21 right away. X Limited is a shoe manufacturing company, is all equity financed, which means it has only equity in its capital. All right. I would really want everyone to be here till the end. Sir, it is all equity finance with the paid up capital of 10 lakhs. Okay, rupees 10 per share. All right. X Limited has hired Swastika. So there's this company X who has hired Swastika to analyze the future earning, and the report of Swastika states the following. I am X Limited. I have hired you being Swastika, and you have given to me the following report. What report you have given? You said that the earning and dividend will grow by 25% for the next 2 years. For the next 2 years, my earnings and my dividends will grow by 25%. All right, fine, easy life, cool. Second, and people, I would stop at this point. I'll have to stop at this point and I'll have to really take you to the concept actually. My bad, because I feel we can do the concept as well and then solve the question. That will be better. Everyone in the class, I would need your quick response. Are we able to switch to the concept immediately? Sir, do you people learning this particular concept from here? Everyone? Sir, where we said that the terminal value is stand at a point from where if you look at the future, you will have only one growth rate, and that is the point where you calculate the terminal value. Come on, quick. Has that been the learning so far? Kindly respond. Has that been the learning so far? Kindly respond, everyone, quick. If I ask you to do the terminal value calculation at the end of third year, will it be the correct calculation is my question. If I ask you to calculate TV3, will it be the correct calculation? What do you say? Yes or no? One word answer I need. Tell me. Quick, 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 quick. Yes or no? Is it possible for me to apply the variable growth model where the terminal value calculation is made at the end of third year? Prachi says no, Gauri says no, others in the class please. I know that the growth rate for 3 to 4 is 8%, 4 to 8 is 7, and then again it is 7. Come on, others in the class please. If you don't involve yourself, have you people been to one-sided love? Where only you are putting in the efforts, not the other side of the chat. When you say something, the reply from the other side is yes, okay, thumbs up, emojis. That's all the replies have been. Where only you put in the effort, the other side. Have you been to such situation in your life? Yes or no? Come on. Obviously you must have been. If you have been through that situation, let me clearly tell you that is how exactly I am feeling at the moment. Come on. Because when I am putting in more than 100% to this relationship, and what I get to hear from you is not even a proper yes or no. So you should realize karma is a bitch, huh? If you do this to me, then at some point in your life will come a point, at some time in your life, where you will similarly making an efforts to message him or message her, and similar kind of replies you are going to get. Okay, this the saddest smiley ever, this the most simple plain smiling smiley. No? So be prepared for it now. Okay, karma leaves no one. Up to person. So this is not personal. So anyways, if I ask you to calculate the terminal value at the end of third year and solve the question, you will say that sir, we cannot solve it. Let me now tell you, we can solve it. Everyone in the class. We can solve the entire question even by using even by calculating terminal value at the end of third year, and people, you will get an answer and the correct answer. But sir, how the hell is this possible? How the hell? How the hell? Sir, because you clearly told us, look at the point from where if you see a constant growth rate, that is where the terminal value is calculated, like year 4, and that's what we did. But can you please go back to the past? I mean, not your past, that love life past. The past of this lecture, everyone, where we said the growth rate. What is the condition of Gordon's model? The growth rate should be constant. But growth rate from which point to which point? Should the growth rate from 0 to 1 necessarily be the constant, or from 1 to infinity? Come on. Come on, come on, come on. Growth rate is a constant growth rate from 0 to infinity or 1 to infinity. Everyone in the class? Sir, from 1 to infinity, which means can the growth rate from 0 to 1 be different? The answer is yes. Similarly, sir, if I calculate TV3, I will make use of D4 divided by K minus G, which means The growth rate is needed to be constant from which point to which point? 4 to infinity or 3 to infinity? What do you say? Sir, 4 to infinity. Which means, can the growth rate from 3 to 1 be different for me to be able to apply the Gordons? The answer is, everyone in the class, yes. For you to be able to apply the Gordon at third year, the growth rate from 4 to infinity should be constant. 3 to 4 growth rate can be something else, and we would still be able to apply the Gordons. Am I strictly everyone in the class clear on this, please? What do you say? What do you say? If the answer is yes, let us try to imagine it. People, let us try to imagine it. Sir, I was ideally supposed to stand at 4, TV4. But as per this alternative, which is alternative T, I will come a year back. I will come a year back, right? And from this year, everyone, on this year when I stand, I will calculate TV3. Please give me the formula of TV3, sir. It is D4 divided by K minus G. D4 divided by K minus G. And can you please tell me, everyone, the clarity of concept you need to touch? Can you people please tell me from which dividend to which dividend it is giving me a present value at the end of third year? Sir, from 4 till infinity. Right from dividend of fourth year till the dividend of infinity, it is all discounting and giving it to me the present value at the end of third year. Please do this a small rectification, people. From D3 to D infinity, we are all set. D4 to D infinity, all the present value has been there in T3. Which means, can you please now imagine the manual discounting? From 4 to infinity, everything is there in 3, which means now I just need to manually discount 1 and 2 and 3 and 3. That's all the table look like if I want to follow the alternative to everyone in the class. Did you people in the class realize the point I'm trying to make here? What do you all say? Did you people in the class realize the point I'm trying to make here? With that logic, everyone, you can calculate the intrinsic value at 0 point. Sir, we didn't do this calculation in the class, but let me tell you, answer as per both of them is going to be 100% same, obviously subject to rounding off. But the answer as per both of them, when you try at home, try these things at home, and you will realize that the answers are turning out to be same. What is the underlying logic? Has that been conveyed? Come on, quick. If you say yes, I am ready to take you immediately to that question. People, please, we are short of time. Now I tell you one thing. Sir, how do we figure out which alternative to apply, whether alternative 1 or 2? Array, how do we figure this out, which alternative to apply? Everyone in the class, that is the clarity you are here to attain. Sir, whenever in the question you see that the payout ratio is changing. For example, examiner says that for the first 3 years payout ratio will be 60% of my earnings. I will distribute 60% payout, but at this point the payout ratio will change. Everyone in the class, please remember to apply alternative 2, because that is what the institute has been also doing. Am I? People in the class, clear to you on this, please? But sir, how do we remember all these things? You don't have to remember, all these things have already been written. Sir, which alternative to apply? Which alternative? Alternative 1 is always preferred. However, alternative to apply in the questions in which payout ratio in the future years is changing. Am I clear? For which you should give the reference of question number 21 as already given in the OutNotes. Done? So let us look at question number 21 again. I need your energies for the next 15-20 minutes. Come on, please. Sir, dividend and earnings will grow at the rate of 25% for the next 2 years. So earning 25, dividend 25. Done. Look at the beauty of the question. Sir, earnings are likely to grow at the rate of 10% from third year and onwards. Sir, for year 3 and onwards, the earnings will grow at the rate of 10%, right? Further, there is a reduction in earnings, the dividend payout ratio will increase to 40. If the growth rate of earnings decreases to 10, from 25, if the growth rate decreases to 10, people in the class, my payout ratio will change to 50%. How much is the payout ratio now? I don't know. So for year 1, For year 2, how much is the payout ratio? I don't know. But for year 3, the payout ratio will change to 50%. That is what the question is trying to say. Don't apply any concept, just try to process the data given to you. Give me a response to this. Are you able to process the data given to you? Everyone in the class, please. Everyone in the class, please. Come on, come on, come on, quick. Come on, quick, please. So first and very first thing you all need to realize that the growth of earnings and the growth of dividends are two different things. For me to value a share, for me to find out a value, what is relevant to me, the growth of earnings or the growth of dividends? People in the class, give me a response. Give me a response, please. For me to do the valuation, what matters to me, the growth of earnings or the growth of dividends? People, Soumya, you listen to me in the meantime. Soumya, question says for the first 2 year dividend and earning grow by 25. So see this first 2 years. This is 0 year, this is 1 year, this is 2 year. 25, 25. Right? The next one, Soumya, earnings are likely to grow at the rate of 10% for third year and onwards. So this is earning third year and onwards 10% every year, right? Further, there is a reduction in earning growth. So further, if if there is a reduction in earning growth from 25 to 10, right, the dividend payout ratio will increase to 50, the payout ratio will increase to 50%. So please imagine for this year, for the year from 16 to 17, as the growth rate has fallen to 10, the payout ratio will increase to 50% every year. Right now, how much is the payout ratio? We don't know. Is the data clear? So my question was, for the purpose of growth, for the purpose of valuation, the growth rate of what matters to me, earnings or dividend? People, at least 1000 times in this power batch itself, I have spoken that I need the growth of dividends. Growth of earning doesn't matter to me. To me, I am discounting the dividends, so growth of dividends will matter to me. Right, people? Okay. If you don't realize, someone will by mistake ending up solving this question on the basis of earnings growth only. Come on, I need the growth of dividend. So fine, what is the problem? What is the problem? Can I assume the growth of earnings to be the growth of dividend? What do you say? Can I assume this to be 25, 25, then this from this point onward 10, 10? The answer is big no. Second concept, how many of you remember that, sir, if my payout ratio changes, at this point, if you realize it is changing, the growth of earning and growth of dividend are not same. People, my earnings are growing at the rate of 10%, then dividend will not grow at the rate of 10%, they will grow at some other rate, is what I'm trying to tell you. Do you agree to it? Sir, what is my right now payout ratio? Let us check. Sir, I have been given the past data. At the end of 2014. At the end of 2014, I stand, if you realize. Right? Sir, earnings are 9.6, dividend is 3.84. So 3.84 divided by 9.6 is, everyone in the class, 40%. Do you realize the payout ratio is right now 40%? The payout ratio is right now 40%. But if it changes to 50, then earning 10% growth will not be dividend 10% growth. Do you realize this particular thing I'm trying to explain? Yes. So, okay. This particular thing tries to teach me one very important thing I will mention right away. But sir, if I want to predict my future dividends, how do I do it? Because this particular growth I don't know. So let me one thing clearly tell everyone. Listen to this carefully. Whenever the payout ratio is changing on a future date, I stand here. Whenever a payout ratio is changing on a future date, don't directly apply growth to the dividends. Don't apply your growth to the dividends. What should you rather do? Listen to me. What should you rather do? Apply growth to the earnings. And on the basis of whatever amount of earnings you get, multiply the payout ratio to get the amount of dividends here. Everyone in the class, could you listen to me? For example, do you see that I'm creating a table of EPS here? Why? Because sir, I need to apply my growth on EPS. And on that number of EPS, if I apply a payout ratio, on that number of EPS, if I apply out a payout ratio of 40%, I will get the amount of dividends. Did you understand me, everyone? Sir, why do I need to do so? Because let me tell you, you grow dividend by 25, you grow dividend by 25 here. Do you have the dividend growth here? If no, how do you find out this dividend number over here? How do you find out this dividend number here is my question, everyone in the class. You cannot find out, right? Which is why better you follow this, Am I clear to you? Requesting your responses, people in the class, please come on. Don't apply growth directly to dividend, rather apply it to EPS and then apply payout ratio to find out the dividend. Come on, everyone in the class, quick. When would you do it? When the payout ratio changes. So, okay. Ultimately, don't forget the core. It is a variable growth model. I need to calculate the present value of future cash flows. My answer, question number 1, alternative 1 or 2. In this question which you see, what will you apply? Alternative 1 or 2. Alternative 1 or 2, accordingly I will frame a table. Learn with me. Alternative 1 or 2. Come on, quick. Had it been alternative 1, if it would have been alternative 1, where would you calculate TV? Tell me. Where would you calculate TV? Any student who looks at the growth of earnings, kindly exit the session immediately. Don't even try to look at the growth rate of earnings, try to look at the growth of the dividends, because that is what matters to me. Had it been alternative 1, where would you calculate terminal value? Sir, at the end of 3 years. Because sir, it is only at the end of 3 years when I stand and look at the future. It is only at the end of 3 years, if I look at the future, I get a constant growth rate forever of 10%. But sir, how do you know this? Because please listen to me, the clarity of concept is to be heard. Sir, do you realize at the end of 3rd year, the payout will be 50? And then onwards, it will continue to remain 50. It will continue to remain 50. So growth in earnings, can't I say that to be the growth of dividend, since the payout ratio after that point is constant? What is the underlying logic? That sir, for a particular year, growth from year 2, 3, if we calculate the growth from year 3 to year 4, right? If the opening payout and the closing payout matches, then growth in earning is growth in dividend same. Do you realize the payout ratio is changing in the 3rd year? In the 3rd year, when the growth falls to 10% from 25, the payout changes here. After that, the payout remains same, which means the growth in earnings is growth in dividends. And since that is same, now you tell me, as per alternative 1, where would you calculate TV3? Sir, at the end of 3rd year. At the end of 3rd year, when I stand and look at the future, I'll have a single growth rate of 10%. But if it is alternative 2, where do I calculate my terminal value? Sir, at the end of 2nd year only. At the end of 2nd year, I will calculate my terminal value, which means I need D3, I need K, and I need G. What a beauty, which means the question has been all simplified, that I will need the dividend of 2nd year, I will need the dividend of 3rd year, dividend of 1st year, I need the dividend of 2nd year, and for TV2, I will need the dividend of 3rd year. These 3 things, if I discount, I will have my intrinsic value, which is what the question is. Could I, people in the class, with all my thought process, explain to you the entire question? What do you say? Could I, people in the class, could I explain the entire question with my thought process? Everyone, please. Come on. Quick, come on. Which means, do you realize that, sir, if I need TV2, I need D3. And to be able to calculate D3, everyone in the class, this is third year, to be able to calculate D3, please realize I have to go by way of earnings. And which is why I say, how will the columns look like? The columns will be, sir, year 1, which is 2015, year 2, which is 2016, and again year 2, which will be 2016, the terminal value. The terminal value. Sir, what will be the EPS of year 1? Let us do it now. Let us. Sir, my EPS at 0 point is 9.6. It will grow at the rate of 25%. So 9.6 plus 25% is 12 earnings of first year. Again plus 25% is 15 as the earnings of second year. Let us first think about the dividend. Sir, let us keep the payout ratio to be 40%, which is the same payout ratio as present, right? So 12 into 40% is 4.8 and 15 into 40% is 6 rupees of dividend of year 1 and 2. Now I need D3. For TV2, I need D3. Please imagine D3 with me. Sir, first I calculate E3, and to the E3 I will apply the revised payout ratio of 50%. I will be able to calculate D3. So what is earnings of second year? 15. That earning will grow at what rate? Examiner says 10%. Examiner says 10%. So 15 rupees of earning of second year. When grows by 10%, it becomes earning of third year. When multiplied by 50%, it becomes the dividend of third year. Divided by K minus G will give me the terminal value at the end of second year. Come on, come on. Sir, 15 plus 10% into 50% divided by K. The question is here. 15% K. We have not read the question entirely. 15% K minus the 10% growth rate, which means divide by 15 minus 10, 5, divided by 0.05, 165 being the terminal value. People, when every student in the class is settled till 165, let me know, I will take you ahead. Let me know in the chat box whenever you guys are settled till 165 people. Please. I will take you ahead. Yes, yes, yes. Come on, please. Usha Rani, yes. Jahan, yes. Gauri, yes. Chandana, yes. Sai, Gopi, everyone in the class. So, sir, what is left now? I have dividend of first year, dividend of second year, terminal value at the end of second year. Sir, present value factors I can calculate at the rate of 15%. Let's do it. Let's do it. Sir, 1.15 divide equal to is 0.8695, which means 0.870. 0.870, 0.756 and equal to 0.658. Multiplying this with the cash flow will give you the final answer. How much do you get it? Everyone in the class, please tell me right away. Right away. Oh my God. And if you really like this, 133.45, that is what Gauri is saying. Others in the class waiting for your answer. Anju, where have you been since the morning? You were missing. 133.45 has been the answer to this question, which means, do you people even realize? What a beauty, everyone in the class, this question has. Sir, to think the question, it took 10 minutes. To solve it, it took 2 minutes. Did you realize such a small solution to such a huge question, and with my best conceptual clarity, it has been delivered to you. But you don't have the rights to leave the session now. Everyone, how much out of 10 will you rate your understanding for this question? Come on, people in the class right away. How much out of 10 will you rate it? Every student sitting in the class, please. Gopi, Usha Rani, Yash, Gauri, everyone. If it is 7, be rightful of saying 7. It is all fine. Jahan, Vaibhav, Chandana, Gauri, Yash, Usha Rani, Soumya, Sai. Great, great, great. 10 out of 10. Thank you so much, but you don't have a right to go. Let me conclude what this question has particularly tried to teach you. First, it has tried to teach you that whenever the growth rate will change, whenever the payout ratio changes, do you remember that particular logic? That if the payout changes, don't take the growth of earning to be the growth of dividend. Learning number one. Learning number two, 1 second, you can't go, be here. Learning number two, sir, if the payout changes, I'll have to apply alternative two. Learning number two. Learning number three, if the payout changes, don't directly prepare the table of cash flows or standard format, because you can't directly add growth because you don't know the growth from 2 to 3. What do you rather do? Rather go by way of earnings and apply the payout ratio to find out the growth if the payout is changing. Is the third learning clear to you? Make one more column as the column of EPS. Right? Are the learnings, everyone in the class, clear to you? And you must be wondering, sir, how would we remember all that? You don't have to. Please look at this. When do you apply alternative to is return? Right? If the dividend payout is changing in future years, then growth can't be directly applied to DPS, that you know. Therefore, such growth is rather applied to EPS, and then DPS is calculated using payout ratio as done in question number 21. Did you realize you can't directly calculate growth in DPS? And that's all question number 21 was about. Now you will have to literally like the video. Now a like is deserved, if you have not earlier. So great, that was question number 21 for you people. Question number 22 is homework. 22 is homework. Yes, let me tell you, you find this question heavy because it was. I had a choice to not teach you all these things. I know a lot of people have already done this question at some point in their life where they didn't think all this, whatever is needed to be thought. You know how our students rather taught this question? They are not made to differentiate the growth in earnings and the growth in dividend. They are taught, see the growth in earnings in 10%, let us apply the terminal value here. Bro, what are you doing? Earnings are irrelevant, dividend is relevant. Because once you know the concept, then only you have the strength to apply them in the questions, and when you apply them, you find them a bit heavy. I know the reality, how the things are being taught to the students. I know it. Sai Prasad, exactly. I think you are able to connect to me now. So great, people, great. 21 would need a revision. You all revise it at your own once. All right. 22 question is homework, as I said. 22 question, people in the class, is homework. Okay. What is the point of learning in question number 28 is very simple. The required rate of return for two different phases is different. Let me explain to you just a minute in timeline and you are all set to go. People, imagine that this is 2003, this is 2008. I have a stable growth rate here and then a variable growth. I mean, the TV calculation is at this point. For this, the K is different. For this time, the K is different. What is the implication? When you discount all these cash flows, while calculating terminal value, use this particular K, because that is applicable to that period. And once you have the terminal value done, you will discount the dividends manually, and the terminal value, use this K, because this K is applicable to this period. Everyone, could I convey to you the only catch of question number 22, please? Two different K for two different time periods, so accordingly use the K which is relevant. That's all the concept is. Such a simple question. 22 is. This much is needed, this much is sufficient for now. When you solve the question, you will automatically get to know what is needed to be done. That's all. So great, people. With that, I think let us call it a day. 23 onwards, we will figure out whether it's to be done, not to be done, what to do, what not to do. Shall we? With your permission, call it a day. Are you settled, please? Yes, that you look at the question at home once, then we figure out something. Cool? So all right, people in the class, thank you so much for watching up these lectures. If you are really liking them, kindly share them with your friends, with your colleagues, whosoever you can. All right. So bye people, take care. I'll see you back again tomorrow on the content browser at 4 p.m. Right. I'll share the technical team's number on the Telegram. You'll approach them. OutScanner, I'll upload it in the Google Drive. Done. OutScanner, I'll upload it in the Google Drive. Done. Yes, you have received an email which has the serial key and all the details related to content browser, including the help videos. You watch it, everything will be 100% clear to you. Okay. Bye people. Thank you so much for being live, being interactive and being there. Take care. Recorded people, thank you so much for watching it up. Bye.